Hello, everyone. Happy Monday. Today on the final bar, we'll hit our normal Monday approach, which is the market from three directions: top-down macro, sector rotation, bottom-up stock picking. On the macro perspective, the S&P unable to get back up to 3,400, sort of chopping around today, with the NASDAQ really driving the way higher with tech, along with consumer discretionary and real estate up at the top of the return list. From a bottom-up perspective, we're going to look at some of the top-rated stocks in each sector. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller, Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every day after the close for our show. As we make sense of these markets, we look at the charts together, empower you to hopefully build your awareness of what's happening, identify ideas, manage risk, and take control over your investment decisions using the powers of technical analysis, of charting, of sentiment, et cetera, et cetera. You know, the general themes we've been talking about, and if you missed Friday's show, our Wrap the Week segment, I think hit on some of these big macro themes pretty well. We're going to revisit them a little bit today, but it's all about the S&P 3,400, and I'm hearing a mix of things. Either some people saying, yes, we finally have hit 3,400. This is the double top. We're going to look back and see this as a textbook double topping pattern, and we're going to start the next leg down. And the others saying S&P 5,000 plus, or some crazy number in years down the road, and how we will inevitably get there. It's just a question of when and how quickly. So a lot of themes to try to go through. Again, I think on the individual names, that's where you identify which of those scenarios is more likely to happen. Coming up on the show, we have some great guests to help us evaluate what we're seeing. Jesse Felder is going to join us tomorrow on August 18th. On Wednesday, the 19th, Katie Stockton. And then on Thursday, August 20th, Samantha Leduc from Leduc Trading. Earlier today, we actually premiered our latest episode, which is going to be the last episode of season 1 of Behind the Charts. This is our interview style show. We had such a great time capturing interviews with top traders, educators, strategists, and learning about their process and how they've done it. We're going to take some time to work up our second season, and we'll look forward to unleashing that on you very, very soon once we get back on the interview circuit here. So let's get to our market recap. As I mentioned in the intro, on Mondays, we start with a macro top-down approach. We finish with individual stocks, and just try to hit on as many of those themes as I can. Let's look at just what happened today. The S&P, as I mentioned, the big story looking at a daily chart of the S&P is this key 3,400 level. So, we went from the February peak to the March low. We have now round tripped essentially to 3,400. And the question is what's next, right? And my base case, what I've sort of thought of is, I think no matter what, if you are long-term bullish, I think you could see the value in a healthy pullback from a key resistance level. This is how you build up some additional momentum and gives you, new buyers can enter in. It gives a chance for people to take profits, sort of reset their expectations and push to higher highs. If you're bearish, obviously you'd be interested in the market going lower from here. And so the first step is sort of testing the previous support level, testing the 50-day and breaking through those. Either of those scenarios, if we keep going higher, just go right through 3,400 like nothing happened, I think that's a bit of a concern, if you're long-term bullish, only because we haven't had enough backing and filling. You need to have those breaks in there, which allows momentum to build for the next move higher, right? Stocks just don't go from point A to point B. They have an impulse and then a correction, a rise and then a pullback. And that's part of a normal push and pull within a longer term trend. And I think we're due for one of those. So I would say my base case is you pull back around a 3,200, 3,250. I think at that point, we'll have to assess where we're at relative to those key support levels. And in particular, what happens on some of the key individual names that we've been looking at. We're going to hit a little later on some of the key charts, in at least one from each of the 11 S&P sectors, and just things to look for. Getting back to the dashboard here, so key stories from today: the Nasdaq really leading the way higher than the S&P 500, with the Nasdaq 100 up over 1% today. Looking at other asset classes, bonds stronger as well, precious metals stronger as well. So this is one of those scenarios where stocks, bonds, gold all went higher. The only thing that didn't was the US dollar, which has gone back to weakening, sort of down after improving into Friday's close. So bonds up about 0.25% if you look at the TLT. On the commodity side, most things up today, with gold up 2% and silver, which has rebounded off of a huge pullback. Gold and silver last week had those big pullbacks midweek and then rallied back to close in decent shape at the end of the week, continuing that uptrend today with silver up over 4%, the GLD up over 2%. Let's look at a chart of gold here really quick, because this is a theme we've talked about. Gold, the rise in gold, is one of those examples where you have to expect some sort of pullback, and it's all about the pullback is going to come. We all know it because it's gone vertical. It's unsustainable for it to just go to 500 from here. So at some point, if not many points along the way, you have a healthy pullback. The question is, how far do you pull back, and what does it look like when you do so? So if you start the clock at the June low and you connect it to the peak that we saw about a week and a half, 2 weeks ago, you'll see that we pulled back right around 38.2%. We retraced that June to August run. And what's interesting is you can see that 38.2% level right around 180. So we closed below there one day. The very next day we went back higher, and now we've gapped up again today with the GLD up around 186. So based on the overall trends, that's about a good pullback. I mean, within the context of this trend, that's a pretty good pullback. I could see it continuing to appreciate from here. If and when it would break down through 180, that would cause me to revisit sort of the bullish thesis and start thinking about deeper pullbacks. And the next logical one would be right around 170, 172. That's the next Fibonacci level. Also that sort of intermediate low in July. So that would be the next level I'd sort of key on. But at this point, sort of bouncing off of a support level, that makes sense. The question is, do we resume and do we break to new highs, or do we continue to chop around that short-term support level? Thinking elsewhere, later in the show, we're going to get to a little deeper looking at sectors and things like that. But I just wanted to hit on some of the themes that we saw today. All the China-related ETFs finished pretty well today, with the MCHI, the FXI, the KBA, which are different, ETFs with different weightings and different mandates, but those were all up around 2 to 3%, depending on which one you're looking at. Taiwan as well, up almost 1.8%. So certainly a bit higher on some of those China ETFs. We haven't looked at some of these in a while, but taking a look at the MCHI, it traded above its January high here, and that was an interesting gap higher on the MCHI. Since then, it actually has sort of this little rounding, short-term rounding bottoming pattern, right? So you had the lower high, lower low. Now this is coming up. You have a new swing high, a new swing low just above 71, and now it's appreciating a little bit more. So it actually looks like a nice sort of pullback, nice little corrective pattern within a long-term uptrend. So actually a sort of a constructive chart on here, and that's after it came off at times. We put in the short-term lower low in late July, and I was starting to think maybe this is the beginning of something deeper, something a little more painful. But overall, it's actually held up really, really nicely. So that chart is setting up for arguably the next leg higher. In terms of industry groups, Tesla was up big again today after bottoming out short-term last week and then turning around and improving into Friday. It's continuing that upswing today. So that group, that automobiles group, and also you have GM and other stocks up as well today, up almost 10%. Again, that's driven primarily by Tesla's rally. Mining and gold mining, so that's Newmont Mining and others. Home builders, so these are some of the groups. Semiconductors, these are groups we've talked about are sort of those key groups that you'd want to see improvement in to feel pretty positive, especially home builders. Some of the long-term charts of home builders are some of the more constructive charts out there. Semiconductors, a huge tell, I think, for the overall environment, and all of those sort of in the green today in a pretty decent way. In terms of what did not work today, it's airlines, it's hotel and lodging, it's banks, it's aerospace. So these are some groups that we're pretty comfortable with having those in the lower end of the return spectrum. And that's sort of what it is. So today was a little bit more of a, back into what has been working, away from things that have not been working. It's sort of the, things are going to be okay trade is how I would describe today. So sort of more of the same, hopefully building confidence for further upside here. That's our market recap for today, sort of thinking about the top down primarily. We're going to get to our next segment now called sector setup. So the idea is let's look at the 11 sectors, how they're comparing to each other, how they're relating to one another, see what sort of themes we can tease out at the sector level. And again, what I'm hitting on here with top down, with sectors, and with bottom up individual stocks, that is a process I hope you think about in your own routines. How are you approaching each of those three? And make sure there's probably one or two of those that you could be spending a little more time on. And if I can give you some ideas of how to do it, that would be great. To start our discussion of sectors, we're going to focus on the RRG, the relative rotation graph. This is Julius de Kempener's creation. Check out his show, Sector Spotlight, if you're unfamiliar with this. He does a great job of explaining how to use the methodology. But in general, further to the right means outperforming, further to the left means underperforming. The vertical axis, the y-axis, is essentially the momentum of that, sort of the second derivative there. So further to the upside means improving momentum, to the downside means weakening momentum relative to that trend. And so if you look, the strongest sectors, according to this methodology, just based purely on their direction on the x-axis, is technology, then consumer discretionary, then materials, then communication services. So further to the right means strongest. The worst performers are the biggest underperformers: energy, utilities, financial, real estate. No real surprises there. The interesting bits, I think, here come with the direction of the tails. That's looking at the last 4 to 5 weeks, and it's showing you how the trend has evolved over time. And if you look in general, I always think when something's heading northeast, that's sort of the direction of improvement. When it's going southwest down into the left, that's sort of the direction of destruction, or probably come up with a less painful way to describe that. That's kind of how I think of it. So real estate, for example, an example of an underweight according to this methodology, or something that's clearly underperforming with momentum that is not going the right way. It's in the lagging quadrant heading southwest. If something was in the leading quadrant heading northeast, which we really don't have right now, that would be the most constructive. So we're left with the best of what's here. So technology is in the weakening quadrant, totally fine. It has continued to be the strongest performer for a number of weeks, if not months. And it's sort of chopped around this zero level. It sort of goes back and forth, keeps round tripping around in a circular motion, just in a real tight area over here. That tends to be something that's in a long-term uptrend, and it's just the trend overall remains positive. That's why it's so far over to the right. And it's just sort of going in a cyclical nature between improving momentum and weakening momentum, which if you look at the relative strength line on the XLK, that's about what it looks like, right? The long-term trend overall is up and to the right. It's outperformed handily. But what's struggled has been, not struggling, but I mean, in the short term, you've seen fluctuations, up moves and down moves within that longer trend. And that's kind of what the RRG is reflecting here. Materials, it's interesting, is up here in the northeast area of the chart. It's kind of heading south at the moment, which is not ideal. That sort of tells you the momentum is coming off, but still one of the stronger performers. And as a reminder, it's not just metals in there. I mean, materials actually has a bunch of different groups in there. It's worth looking at some of the other groups within materials, things like chemicals and other places, to see where there's some opportunities. But as a sector, it's actually done pretty well on a relative basis. Consumer discretionary as well. So this rotation, we talk about leadership rotation. I think the way that the RRG kind of makes sense of that is if things continue to rotate in a clockwise direction. If you see some of these defensive sectors, things like maybe financials, industrials, continuing to rotate more toward the leading quadrant, we haven't necessarily seen the follow through. So when financials start to improve, they then rotate lower. And again, you saw banks were one of the worst 10 industry groups today. So that's sort of a phenomenon that keeps recurring. In terms of things that are emerging that I'm paying attention to, I think the strength in industrials is a good one. We've talked about that in different ways. And we're going to look later at the chart of UPS, which is just a fantastic long-term chart. It's obviously rallied very, very well. It's performed very nicely, but there are other groups within industrials that have improved, and it's not airlines, it's other parts of the sector. So that's an interesting one to see if that continues to, if you can continue to see good charts within there, which I think you do. Healthcare is actually, in the lagging quadrant, but rotating more positively. So it's been underperforming, but the momentum is starting to, ease off a little bit. And I think with biotechs, that's sort of the main group I would be looking at there. And then consumer staples. So if you look at some of the charts within staples, they're not bad. And it's things like Kraft Heinz and Clorox and what else comes to mind? Church and Dwight, CHD. These are charts that are actually pretty decent long-term charts that are in a position of strength. The average stock has suffered a little bit on a relative basis, but overall the momentum is sort of heading in the right direction. So those are two sectors I would be looking for improvement, along with industrials sort of rotating to the upper right. Things that I'd be looking for weakening. Communication services has some fantastic charts. We're going to look at Take-Two in a little bit, which is one of the better ranked names within that sector. But a continued deterioration of that on a relative basis using the RRG would be something to pay attention to as well. Let's look at the 11 S&P sectors. This is using the candle glance page. It's a great way to just get a quick visual on what's working and what isn't. And I think what jumped off the page at me as I was reviewing it is consumer discretionary just appearing to be long and strong up and to the right, blew through its February highs, and it does not appear to have looked back at all. You can see technology with some fluctuations, but overall the trend remains very positive, and both of those sectors are above ascending long-term moving averages. Communication services I put in that same bucket. The reason I talked about healthcare and staples as some potential emerging opportunities, the relative strength in staples is not, super impressive. It's sort of been flat since the June market high, but you can see on an absolute basis, it just in the last week has now broken above its February highs and in a position of strength. So it's a decent long-term chart, not too bad on an absolute basis. Here's healthcare, and you can see the relative strength of healthcare has been essentially sideways again since the June peak. It topped out in June, sort of similar to that January high, pulled back to the 200-day, but now has broken to new swing highs, pulled back to 104, and now making a new 52-week closing high here today at the end of the day. So overall, setting up really nicely as well. One other one I want to point out here very quickly is financials, ticker XLF. And you can see if you look at a chart of financials, this is why the chart is a bit of a concern for me. The XLF rallied from the March lows, hit a peak in June, came off and hit the 38.2% Fibonacci levels, right around 2250. From there, it came right back up to resistance, and this was a confluence of resistance around 2570 or so. And this is basically hitting a moving average, hitting the Fibonacci resistance, also letting into that same range that we saw back in June. So overall, now pulling off the 200-day, I would expect this to be going back lower. And I think the first support level is the 50-day moving average, which has worked in the last couple of times. But I think 2250 is not an unreasonable downside target for something like financials. We're going to highlight at least one stock in the sector that's holding up pretty well, but overall, a bit of concern with an industry or with a sector failing at a declining 200-day moving average. That's our sector setups for today. I want to take a quick commercial break. We'll be back with shifting stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. So good to have you join us on the show every weekday after the close. As a reminder, tomorrow on Tuesday, we'll do our next Final Bar mailbag segment. We'd love to answer one of your questions live on the air. So just shoot us an email with any questions you have about the markets, about a particular technical approach, about a particular ticker, whatever it is you're looking at. We're happy to answer your questions and review them together. So shoot us an email. The final bar at stockcharts.com is the best way to get a hold of us, or on Twitter, just tag us in a comment at finalbarsctv. We'll gather all of those, and we'd love to answer one of your questions in our mailbag segment tomorrow. Our final segment for today is called Shifting Stocks. So now we've talked about the top-down macro, the S&P testing 3,400, gold, bonds, all appreciating as well on the weaker dollar today. We talked about sectors and focused on things like financials that are starting to fail at key resistance, but the average sector, if I'm looking at things like tech, like consumer discretionary, like others, in pretty much a decent setup with healthcare and consumer staples setting up with potentially some relative outperformance. Now we get the third pillar of the stool here, which is the shifting stocks, looking at individual stocks. And as we've talked about before, part of my process is once a week, usually on a Sunday afternoon, sometime over the weekend, I'll look at the entire S&P 500 one by one, and that's something I've done for years. And I would encourage you, even if you don't trade a lot of individual stocks, the more you do that with consistency, the more that the broad market movements will not surprise you and will make a ton of sense, because more often than not, big movements, inflection points, changes in character will often be reflected through breadth and through individual stock and industry themes before it's registered on the broad market averages, just because it's those are cap weighted indexes we're tending to follow. So today what I wanted to do is just hit on at least one chart in every sector. I'm probably just going to start at the top and get through them and see what themes we can go through. So we're going to start with Take-Two, ticker TTWO. This is in communication services. This is the top ranked, or if not one of the top ranked, I think it's the top scooter ranked stocks. This is in the 97th percentile. So it's basically one of the strongest trends across the entire large cap space. And what strikes me with the chart of Take-Two, again, even though the relative, the RRG on communication services has come off a little bit, you look at the relative performance of Take-Two, and really since the market peak in February, look at how this thing has outperformed. So it's outperformed probably 40% on a relative basis if you start the clock at the February market peak. Because if you look, Take-Two had actually pulled back a little bit. It may, it bottomed out in March as well, but it had already come off a bit from its January peak. It then turned off and it eclipsed its high in May, right? From January. It had gone above to a new high in May. This is when most stocks were nowhere near. We're still sort of, halfway, if not less, of retracing its way back to the previous highs. And from there, it's been lights out up and to the right. So overall, not overbought at this point. It was overbought earlier in August, a couple of weeks ago, but since then has pulled back a little bit. The relative strength remains very positive. Clear support around 165. So I think it's set up to be a nice long-term chart certainly for the next leg higher at the very least. Chart 2, and I jokingly talk about a name you may not be familiar with, Tesla. If you missed our last episode of The Pitch, this was our show last week. There's a panel. We had 3 guests, Grayson Rose, Tom Boley, and Dave Landry. I moderated a really fun discussion with the 3 of them, each pitching 5 of their ideas. And Tesla was one of Tom Boley's picks. If you missed it, again, I'd go to our YouTube channel. It was a fantastic discussion with those guys. They're a lot of fun. But Tesla's one we talked about. And I came clean. I opened up that we have a paper trading competition with the StockCharts TV team, a very informal, more educational experience, trying to look at charts and using the charts together and learning as we can from each other. And I literally exited Tesla in my paper portfolio right about pretty much bottom ticked that one. Had a beautiful long position. I sort of thought, I don't need to be holding this anymore. I'll move on to other things. And it's up another 11% today. So it's funny. There's so much discussion about Tesla as a business model, Tesla as a way of life, as a mental state, Elon Musk and what he's doing. I care very little about all of that. I care very much about the chart and the fact that the chart continues to go up and to the right. So we can debate all we want about the sensibility of this, the company, the CEO, all the news flow around it. At the end of the day, the chart keeps going higher. And in general, I have learned to want to own charts when they're going up and to the right and not own them when they're going down and to the right. And in general, that has kept me on the right side of things. Should have stayed with Tesla because so far it's gone up pretty nicely. But that is the #1 ranked stock, not just within consumer discretionary, but in the entire large cap universe. So it's the #1 name again today. Let's go quickly through the other ones. We don't have a lot of time to get through each of these, but I did want to hit on top ranked stocks in each sector. Within consumer staples, Church & Dwight is the #1 ranked stock. And again, if you look at the daily chart here, it had this nice base that it broke out of in June to early July, just pulling back a little bit. And stocks like this that are rated pretty highly in the top decile of our scooter ranked stocks, they've pulled back a little bit. So this one, a clear support around 92.50. So I think as long as we hold above that, this is setting up for a nice leg higher. You've got a clear support level as a potential exit, as a potential stop level to manage downside risk. But overall, it's setting up really, really nicely. And this is in a relatively unloved sector. So good stocks and sectors that are less on people's radar, I find is really interesting, because if and when that does come in, a stock like this is really going to appreciate based on new flows into the sector. COG, COG is Cabot Oil and Gas. This is there are very few energy stocks that I think have any redeeming technical qualities, to be totally upfront with you. But if I had to pick one, COG is the better one. This is relative to the SPY. If you look at like Grayson Rose, his charts usually look at it at a line relative to the S&P, relative to the VTI, a broad market benchmark, but also relative to the sector. And if you look at COG relative to the XLE, relative to the energy sector, you'll be really impressed by how it's outperformed other energy stocks. While it's not the most beautiful chart out of all of them out there, for an energy stock, it's impeccable. So if you're looking for exposure in that sector, I think it's a decent place to be looking. CME is actually an interesting one. This is not the top ranked financial stock. It's actually one of the lower ones. It's the 35th percentile. But I thought it was interesting that CME has actually broken to a new swing high. It broke above its July high, broken back above its 50-day moving average. I'm looking up to previous resistance around 185, 190, which would be right at previous highs. Also the 200-day moving average, but not overbought, just starting to emerge. I think it's an interesting potential idea. Within healthcare, ABMD, Biomed, this is in medical equipment, so all eyes on biotech, but I think in some of these other groups like medical equipment, medical supplies, I think there's some interesting ideas. This is a good potential pullback name to ride the next leg higher. Within industrials, I'd point out UPS. So this is obviously a gappy name. It's gapped up a number of times on this rally from the low in March and a retest there in April and May. But since then, it's gone pretty well, and it's become extremely overbought, where it's remained for the last 3 weeks, which is pretty extreme. What that in general tends to mean is you'll get a bit of a pullback, which you really haven't had yet, but then you'll have at least one move higher. So it's almost like a buy on the dip sort of mentality when something's extremely overbought like that. Newmont Mining is a really interesting one, and just like gold and silver pulled back last week as gold gapped lower. Since then, you can see the RSI did not breach the 40 level, which is characteristic of an uptrend. It's up again today about 7%, which I think is setting up really nicely above upward sloping moving averages. A nice long-term chart there. NVIDIA, so I'll highlight one within technology. There's a lot of good charts within technology, but this is up again over 6.5%. Relative performance has been ridiculously strong on semiconductors, but in NVIDIA in particular, it's one of the top-ranked stocks in the scooter rankings as well. We'll finish with utilities, AWK, and again, relative to utilities, not bad. Relative to the rest of the market, not horrible, but not great. But this is the top-ranked utility stock. When you get into utilities, you often will get some decent yields. This isn't a huge yield; it's only 1.4%. But overall, the chart has held up pretty well, and I think looking at the resistance around 140 becoming support, 140 to 142 would be key there. And then finally, within real estate, REITs are a tough space overall, up pretty good today, but Equinix, EQIX is one of the better ranked charts. It's in the top 20% based on the scooter rankings. And while the relative strength is not overwhelmingly positive, if I had to own something in real estate, I might be looking somewhere there with the key support level not too far below. That is a rip through one chart from each of the 11 S&P sectors. We'll get to many more of those themes as we continue on through the week. We, however, need to wrap the show. The 3 and 3, 3 charts in 3 minutes. Let's get to it. So chart number one here, let's get to this guy. Chart number one is the chart of the gold ETF. As I mentioned earlier, gold pulled back last week. The GLD came off to 180, and from there rallied really nicely today, up over 2%. So the chart of the GLD is actually setting up really well. I think you have a clear downside level of support just around 180. And as long as we hold above there, I think it's setting up pretty well to retest the highs and go further upside from there. If there's an interruption, if we start to break down through that support though, I would certainly be a little more cautious. Chart number 2 is the New York FANG Plus Index. And I'm showing this just to illustrate the relative strength, the relative performance, excuse me. If you start the clock at the end of December of last year, this basket of names has outperformed the S&P on a relative basis by over 50%. So it's not the return on that index over that time. This is outperforming the S&P by 52% since the end of December. And now, again, this is not just the FANG stocks, but it's a lot of FANG-like stocks, like some of the Chinese internet names and so forth. And then very finally, I just want to highlight again the chart of financials in terms of, when so many charts look good, I think hitting on some of the charts that look less attractive, I think the XLF is one of those. And I think within the sector, again, if you're looking for short candidates, that's sort of the place that I would probably be looking, things bouncing off of resistance and showing more weakness when the market overall is showing a lot of signs of strength. Folks, that's our show for today on a Monday afternoon. Thanks so much for joining us. Another mailbag segment tomorrow, so get your questions in as soon as you can. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.